Welcome to the Real Advisor Podcast, TRAP, TRAP. Please follow us and join in the conversation on Twitter @Advisor Podcast, where you can suggest ideas and themes you'd like the TRAP team to discuss. Also remember to like and subscribe to our YouTube channel and leave a 6 out of 5-star review on iTunes. Doing all this really helps us, which means we can do more to help you. Now let's head over to the studio for the latest pile of TRAP.
Yes, indeed, dear trappers. Welcome back to what many people are calling episode 72 of the Real Advisor Podcast, TRAP Trap. My name is indeed Lick Lincoln, and joining me today in the digital studio of Doom are two of the three other horsemen of the apocalypse, Andy Ultra Heart and Alan the Storyteller Smith. Carl Delavocci, the voice widger. He was at an Irish wedding yesterday. Know thyself. Carl said in advance of the fact, I'll be in no condition to do anything come the day of recording Trap. So somewhere in a particular circle of hell is Carl Widger and his hangover. I hope it gets better for you as the day progresses. But in Wodge's stead, we have, well, what can I say? We have one of the most revered consultants in this thing of ours, Rob Stevenson of Kingmaker, sir. Thank you for standing into Delavocci's shoes. Give us a very quick 20-second bio. We'll delve into more about you later on, but just to give the listeners some context.
Okay, I work for a couple of product providers, a few IFAs. I bought a load of IFA businesses. I set up my own business 20 years ago, and I've been doing it ever since. There you go.
My God, that's
welcome,
perfect.
Rob. Welcome, Rob. For those of you not watching on YouTube, he's got a fantastic fake background. Solid.
Spontaneous lines are the best ones, aren't they, Andy? The ones you just throw out there.
It's a real background.
Seamless.
It's one of the nicest backgrounds.
He's going to get a basketball in a second and spin it on his finger.
Episode 7. Dear listener, by the way, if I'm more touchy than normal today, because we're under the cosh time-wise, so I'll be pushing the boys along at a bit of a canter. So let's go straight off with some more high energy review reads or read, read out by my very good friend, the Right Honourable Mr. Andrew Ursane Hart.
Well, this is an interesting one. It's certainly not a 6 out of 5-star reviews, but we'll read them all out. This is another 1-star, so we've had a couple of these coming in, which is great. We're at the end of our sort of reviews, so please do leave a review. It'll get read out almost immediately on the show. So anyway, this is 1 star from Dude Reno 72. This has become rather dull. If I wanted to hear a party political broadcast for MAGA reform every couple of weeks, I could just tune into Fox or GB News. Also, 100% equities for everyone. Let's shove volatility down people's throats, even if they hate it, but that's okay. We offer behavioural counselling. The thought of the likes of Nick Lincoln offering me therapy during a 30% downturn is enough for the most hardened investor to throw in the towel. Thank you very much, Dude Reno 72. Nicholas, any comments?
No, not really. Only to say in 25 years of advising, I've never had a single client throw in the towel at any of the horrible inflection points that we've had. So,
and you have counselled them during 30% declines.
I have. So maybe some of us can do it and some of us wish we could. And I'll leave it at that.
May have been projection from Duderino 72. Maybe not
sure,
everyone can
careful,
do it. Yeah.
Slip.
I'm sure he or she, but we
Or
know it's a
he.
he. I'm sure he's a very nice chap. Okay, let's give this episode a timestamp with some topical tidbits. Trappist, as you may know, because a good chunk of you were at it a couple of weeks ago, the second of our Trap Live events held at the Royal College of Physicians, Trap Live 25, which was a success. Albeit the room was crammed, which actually is a success as well, because if you're playing to an empty room, you really are screwing things up, and we certainly weren't playing to an empty room. Thoughts on Trap Live 25? Quick recap from the... Actually, well, Rob, if you want to chip in as well, as long as you've got any good things to say. Alan, Andy?
I'll go first then, yeah. It was a great night. There was obviously a conference beforehand, Brett, and there was the DFA film event, so a lot of people were in town anyway. It was a good vibe. Sun was out. People were drinking early on. The event went as best we could have hoped for. Yeah, it was very much overcrowded. The AV worked. We did quite well. We learned quite a lot from it, so we're working already to put something together for next year, bigger and better. It was cracking. Alan?
Yeah, look, it was a success in terms of it was completely sold out. And in fact, we had a few extra people show up on the day. So there was literally standing room only at the back. And we obviously gave away a few scholarship tickets for youngsters on the early stage of their career journey. So, yeah, the room was absolutely packed. The only criticism that I would offer of it is and you live and learn, is that the venue, as much as that's a great venue, it's a great. I know you've held your Humans Under Management there before, Andy. The kind of theatre style is a little bit too formal for me, for the kind of for this sort of style of trap is designed to be. It's not someone standing up and presenting for an hour. It is more of a conversational. The thing that I'm always reminded of, having attended a few of these things over the years, is like a comedy club vibe. You go to a comedy club, up in Camden and the Comedy Store, things like that, where everyone sits around at normal tables. You've got drinks on the table. You can get up and go to the bar or go to the loo or whatever. That's what we had last year at Lola's.
Yeah, we need to find something
obviously
similar.
Lola's is no longer hosting these things anymore, so we had to find a new venue. So that's the only thing. The vibe was a little bit, certainly early on, it was a little bit sort of staid, I thought. But other than that, great success. And we are going to do it again next year.
Final thing on this, you boys were there. 170 people in the room, and then 41 people ended up at the local curry house. That is a successful night. We rocked up about 10:30. The guy's closing up. Keith Button says to him, how many people does your restaurant hold? He's like, what? That's a bit of an odd question. About 35. He's like, we got 42. So we all went in there. We stayed there till about 2 a.m. So the vibe might have been a little bit not too bouncy to begin with, but my God, we ended the night.
We made up for it
on a
later.
Massive high. I think us three got a taxi. All four of us actually got a taxi together, didn't we?
We did.
Anyway, Rob, your independent view of Trap Live.
Yeah, it's good. I was booked in last year and didn't bother turning up, so I thought I'd come this year. Actually, like put in an appearance. It's kind of weird. It was interesting to watch you guys as whales with your shoals of followers afterwards. There's like all these people that are kind of jumping in, and that's good, right? That's like there's a quite young age group. There's a lot of people that are really interested.
Very young demographic, yeah.
Yeah, really young demographic. A lot of people that are obviously really interested in what you're talking about. Next year, Dublin Castle, the bit at the back. There.
Now you're talking.
What about downstairs? Downstairs is a no-go zone.
Yeah. Do you know what? That might not be dear Trappers. So we're looking for a venue in London that's a bit loosey-goosey, ideally a bar-focused venue that can do a podcast recording for about 200 people.
You're right, Nick. It might be a good shout. I don't know if it's big enough.
We've not sold out the Dublin Castle.
Walking distance for Alan to get home.
Yeah, it is.
Okay, all right.
Nick, we'll carry it on because the following day was Abraham's Advisor 3.0 that was in North Greenwich area.
Yeah.
The second year they've held it there. I thought it was a superb day, cracking day. Obviously, we were on a bit of a high anyway. Me and Alan went. The venue was great. I mean, they really went to town on everything. They've raised the bar, in my opinion. Last year, I'm sure he doesn't mind me saying, was a little bit contentious for various reasons, but we'll nudge on. But this year, blew it out of the park. Palatial banquet for lunch, amazing dinner. The club was probably one of the loudest clubs I've been in, and I've been to some serious clubs over the years. So, he did really well. And the content was great, and obviously the community was great. Chris Hoy was brilliant. It's very rare that you get these sort of globally recognised keynote speakers that actually deliver. I mean, he absolutely smashed it out of the park. He did such a good job. Even Alan was quiet during his keynote. So, hats off to Abraham and the team. They absolutely smashed it. So if you didn't go to it this year, do think about it next year. I think they're going to be getting bigger and bigger and better. Over to you, Alan.
Yeah, obviously, it was literally the next morning after I think I went to bed about 3 a.m. that night, quite a late one, after our live event, plus the curry, plus we had a bit of a nightcap after the curry. So it was a late one, man of my vintage, to get up the next day and go again. But go again we did. Andy and I, we went down there, North Greenwich, which is actually surprisingly easy to get to. I thought it was really tricky.
Like
but
a nightmare in your head.
Yeah, where the hell is this place? But it's it's on the Jubilee line, I think. So it's easy access. Yeah. Look, it is now, I would state it's the biggest and best event in our profession in the UK right now. I think, I've no idea, I haven't spoken to Abraham about this, but it seems to me like it's modeled on the US future-proof model. I mean, all right, we haven't got the Californian beaches and the sunshine, but it's big. It's a huge venue, loads of things going on simultaneously, food, music, everything. And it was another quite a late night as well after that, in that, music and dancing. I even got on the dance floor, which is a very rare thing for me nowadays. But it was just a load of fun, really good community. And it seems, and I think, to be fair, we're probably going to piggyback again next year, because obviously Advisor 3.0 will be going again, probably roughly the same time next year. And why would we?
I think they've got the date set already.
Yeah, why would we try to
is,
counter that? So we're likely, it's a bit of a sort of double hitter, and maybe Brett does his thing as well. I don't know. But that's a period of the year in May 2026 that everyone should get into London, get to Trap, get to Abraham's thing. Fantastic. Really, really great experience. Thoroughly enjoyed it. Well done, Abraham and all the team.
Right, now let's get down to the serious stuff. Nicholas.
Okay, good stuff. Good stuff. I'm glad that went well. So in the episode prior to Trap Live, which would have been, even my maths could tell me, that was episode 70, I believe, there was a piece about how private equity is looking to get into UK pensions. And I think I talked about that and said, this has got all the makings of a disaster. And then lo and behold, a few days later, I read an article in the Wall Street Journal, which is still a great thing to subscribe to, by the way. It's not that expensive, and the writing is very good. And Jason Zweig is one of the better US writers, and he wrote this piece about how private equity pushers are looking to get into pension funds over the pond as well. And now Jason's a very nuanced person. If you listen to him being interviewed, he's very mild, very easygoing, but his headline for this was, "This new investing idea isn't right for your retirement plan." So if someone like Jason Zweig, who's very careful what he says, is saying that these alternative assets, these funds run by people like KKR, Apollo Global Management, Blackstone, they're just not fit for personal pensions, or PRSAs, as Carl would say. He's not here, so we'll squeeze that
PRSA
in.
corner.
You know, these funds have limited. So one of the funds that he's looking at has a liquidity tie, and you can only sell out of it 4 times a year. This is not for retail. I cannot believe that the US are thinking about doing this as well, because institutional investors have pretty much filled their coffers up with private equity. So all the dregs now, they're looking to flog that off into the retail market. And so even that's not good. Not only are you going to private equity, which I'm not sure you should be into, you're probably going to go into the shit end of it. So I hope it doesn't come in this country, and I hope it doesn't come in the UK. And there's a link to it in the so-called show notes, because you get a certain number of free links each month I do from Wall Street Journal. So that should be able for you to open up on that, dear Trappist. Okay.
But hang on. I think it is worthy of a second on this, and particularly as we have somebody
We've got
with us,
an in-house expert
who knows a little bit about private equity, private markets. Rob, interested in your thoughts. You know, this is being pushed by UK government right now. There was the Mansion House discussion, Rachel Reeves. And from what I can read, it's kind of a done deal. Quite a few of the big corporate pension providers, I think Scottish Widows were the only one to say not for us.
Yeah, they said no.
L&G and a bunch of others said, yeah, fine, we'll shoehorn this private equity stuff into retail, effectively retail or corporate and
package for the retail market.
Yeah, but Rob, what's your thoughts as an asset class for investors and pension holders?
Great audio for our podcast listeners there.
Most people just listen, Rob.
I just shook my head. Well, look, they're closed-end funds, so for all they're not liquid, and they're often marking their own homework.
Exactly.
If you don't get a result until the end of 10 years, then what exactly is the valuation in between? So it gets technical, but essentially this is late-stage capitalism at the macro level. This is just, where else can we put this stuff? So they're opening up in the US. You've got private equities now available for investment in NBA teams and NFL teams, and it's a behemoth, and it's just the progression of that. A lot of the time when they say we're going to do this, and then they've already got governments on board with it, which is why it sounds like a done deal. So I mean, I wouldn't put my mother's money into something like that, but that's a personal preference. It's a reflection of the fact that, and the other thing is, when people talk about private equities or private equity, a lot of it's private credit.
Yeah,
there's a lot of private credit money sloshing around, which is the debt side of that, and that's another interesting sort of topic. But it's doesn't. I don't personally, it's a personal opinion, but I don't think that will end brilliantly.
No, I mean, if you lift the lid on the actual asset class, what it is it's leveraged smaller cap equity. Most of this stuff is they're not buying Google or anyone. They're buying smaller companies with leverage, with lending, and yes, some of the results in the last 10 years, and this is what people seem to forget, have been pretty positive. Sorry about that, Rob. But they've been pretty positive. But if you've got in the so-called ZIRP, zero interest rate period, that they were, if you could raise capital at close to zero, of course you're going to get half decent return on your money. But those days are long gone. So it's a classic rear view mirror investment strategy, because they'll come up with some figures showing the very, very best private equity numbers over the last 10 years, which by definition were always going to be quite good, versus public markets non-leveraged. It's comparing apples with pears. So I think there's a consensus. It does not make sense for our clients and people that we would speak to.
But this story's not going away. The private equity markets, I believe, are twice the size of the public equity markets. Like the shift is
well, they
is not
see a
going away.
fantastic
But anyway.
opportunity. All this retail money, pension money.
Yep.
Yeah.
All right.
The investment management business is a marketing business, not a finance business. So again, they're going to market the hell out of this stuff. So
And in many ways, if you think
anywhere.
about 2008 or the years that preceded 2008, collateralized debt obligations and mortgage bonds, that all of those things were packaged up so that they could slot them in, get them a AAA rating, and get them into the right type of investment class. So they're creating something to be able to put it into that investment class so that, like a pension fund could buy that. So it's your shades of that maybe a little bit. I know that's a bit over dramatic, but, you can see a similarity between how those things were done.
All right.
Okay, Rob, over to you for your next topic, my friend.
You might have to remind them what it is.
No, I know what it is.
Okay.
James.
So I was looking a couple of things. Obviously I do try to pay attention to what's going on in the M&A market. It's kind of quite close to my bank balance. So last week, Timothy James and Partners merged with Fidelius. So two companies I know, TJP a little bit more than Fidelius. What I think is interesting, and I know we're going to come on to talk about Mattioli Woods merging with Kingswood. Both of these deals are driven by investors. So TJP, I believe Waverton had a majority stake in TJP. That didn't work. They sold out. And then Soderbergh took a position in TJP. And now Soderbergh then took a position in Fidelius, and then there you go, they're all together. So I wasn't in the guts of that deal at all. But ultimately, this sort of comes back to there's a lot of people offering investment in companies, and, it does change the outcomes often. You can't be a little bit pregnant. Once you've got an investor and you're in, you really have to up your game on shareholder agreements and drag and tag provisions and who's really controlling the outcome. There's this wonderful phrase, minority protections, that gets kicked around a lot, which is sort of, as a minority stockholder, we just need to be able to protect our interests. And then when you actually crack the shareholder agreement open after about 9 months of negotiations, it's a very long list of things that they have to protect their interests. So it looks a little bit like, I think I was looking, TJP and Fidelius is going to be 50 advisors and 30 million of turnover. Fidelius also just announced a deal with the BMI.
Yeah.
As like an formal introducer deal there. So about 3 billion of AUM. There's going to be a bunch more debt going in there, and that business is going to become bigger. I'm assuming Soderbergh are still in. They wouldn't, if they thought it was going to be successful, they wouldn't come out of it at that stage. Soderbergh, I think, have got 200 tech developers. So I was talking to a firm the other day, and they're saying they're going to build their own back office kit and stuff, and they were looking for investors. And I just raised the point that Soderbergh have got 200 developers working on their back office systems and integrated sort of CRMs and whatnot. It's kind of, it's not an ad for Soderbergh, but it's hard to compete with that if that's what you're after. Yeah. So, and with Mattioli Woods, that's like, Mattioli Woods was 16 billion of AUM. Kingswood was 13. I don't think it's a trade secret to say that Kingswood was sort of looking for a new home for a period of time. Their investors bought Mattioli Woods back end of last year. Kind of looks a little bit like you put those two things together and you dilute the problems in one and balance them up with the other. That sounds overly simplistic, but I have been behind the curtain. That's kind of how a lot of these things work. So, yeah, interesting times. And I think also, speaks to this idea that you're going to start seeing some quite big businesses coming together as well. And some of the consolidators consolidating each other.
Timothy James and Partners, they used to focus on a niche. I can't remember exactly what it was. Alan,
we both know Tim. Well, Rob knows better than I do. I spent an afternoon at Wimbledon with Tim, and I've never forgotten it. And Rob's smiling knowingly, quite a character. Really nice guy from what I saw. But they did have an in with, I call it the creative entertainment. They had quite a few high-profile clients, famous people. But that's interesting. That whole thing. My understanding is Soderbergh is the Scandinavian Swedish outfit, and they were all about taking minority stakes, which I thought was it was just quite different. But as always, as you've just alluded to there, Rob, the devil's in the detail, because there's minority stake, like we're going to buy a small part of you, give you some, fresh powder to go and do whatever you want to do, grow your company. And there's minority stake where, no, we'd like you now to merge with another one of our minority stakes. I don't know. That's all in the detail.
Well, it's kind of, if you think, like, I'm going to take 30% of your business. First of all, a lot of people think, like, oh, I'm going to sell 30% of my business. They're going to end up with 30% post-transaction, which means they're probably going to ask you to raise new shares, which they're going to buy. So a lot of people think, I'm selling 30%. How much is my company worth? I'm going to get that. It's 10 million. I'm going to get 3 million. It's never quite that, because why do you want to just give people money and just let them walk away? Business needs cash for development. So it's often a mix between how much you actually get to take away and how much goes on a balance sheet. But fast forward 5 years and the business has kind of done okay. You want to sell the other 70%. Who wants to buy that? And then they have to be in partnership with Soderbergh. So whilst Soderbergh are all about, we want to take minority stakes, they're going to end up owning these companies. They are. And they're a big business themselves. So they're going to end up majority owning.
But they're going to dictate the terms on which they buy the...
They're going to have a serious influence in that,
yeah, exactly. Because you can't just take that around the market. Well, you can, but who's going to buy it with their...
Well, you have to take them with it if you're taking it around the market. If you take it alone, that's your first question: are they on board? And again, if you look at the Kingswood situation, that's well publicised. The guys at Citywire poured through all of that in terms of the debt. That's a lot of that. Companies like Ares are hugely influential in financial planning in the UK because they provide a lot of the private credit, a lot of the debt that sits on top of these investments, and ultimately, I think IWP had a lot of debt with them. Kingswood had a lot of debt with them. Shows what I know. I always thought those two companies would probably come together because then you can manage the whole debt, amorphous blob of debt in one place. IWP went to Titan again. This is this sort of second wave of private equity.
It's a whole different. We're going to come in and talk about this in a bit more detail in the meat and potatoes, but it's the one thing I'll say before we move on is that I mentioned this at Trap Live. Just a statistic that I saw a few weeks ago was, I can't remember what the numbers are, but I want to say 30%, 50% of IFAs working in the UK currently work for companies which are backed to some degree or other by private equity. All these consolidations have led to a situation where we are now that, and if you put in SJP in the mix as well, the numbers of pure independently owned, independently non-restricted from a regulatory viewpoint, we're becoming a minority now.
It's shrinking slowly, Alan, but there's still thousands of them out there.
Less than 50% now, which is interesting.
Yeah, shrinking, but still
right.
out there.
I think we keep this clipping along, and as dear trappers, as you might have listened there, if you listen carefully, it's quite refreshing to have someone who's an expert in their field on the show. We're all kind of just
we've got a grown up on today.
I understood some of it. I must admit, I sort of came in and out, but it sounded very good. Bitcoin
talking of
BBS,
things that you
BBS.
know all about, I feel slightly safer to be mentioning this while Crypto Carl is in his hangover sickbed right now. But I just wanted to flag it up. I mentioned this before. We have mentioned on the podcast before, but we've now had this guy by the name of Dan Parkinson, who was a regulated advisor, went really down the Bitcoin rabbit hole, become something of an expert on this emerging subject. Well, not emerging, but it seems to be continually raising its profile. But Dan, under the guise of the Bitcoin IFA, and check out his website and his content, came in and did the very first training workshop for a regulated advice firm, which is my firm. Came in and delivered an afternoon session, a few hours, just kind of exploring the facts, establishing what the myths are, what makes sense and what doesn't, all on the basis of, I always talk about this concept of, it's one of our core values in our business, curiosity, be interested, learn, continue to learn. We, probably have mentioned this before. We do have clients, some pretty successful clients who are investors in Bitcoin specifically, and they expect us to at least have an intelligent grown-up conversation with them about the pros, cons, and everything in between. So Dan Parkinson is now rolling this out. We were his guinea pig. It worked really, really well. I thought it was a fantastic investment of a couple of hours of our time. And so if anyone is interested in learning a bit more, getting him in to run a workshop for their team, get in touch. Check out the bitcoinifa.com, I think, and Dan Parkinson, and speak to him because, as I say, I thought it was an excellent session.
Great. I do subscribe to his email newsletter, very informative. So do the same. My point's sort of following on from that. Bitcoin related, I suppose. It had Bitcoin 2025 last week, I think, which was huge in Las Vegas. Talk about putting on a conference.
30,000 people.
Insane. But the person I'm going to highlight is Michael Saylor, who's the CEO, founder of a company called MicroStrategy. And he's a bit of a maverick. When he first came out a few years ago, people thought he was completely nuts, as most mavericks are initially. But he's gone all in on Bitcoin. His talks are actually world class. He does great talks about private equities, global companies, public companies, the companies that people only invest. He's got a lot of knowledge in this space. And his company, MicroStrategy, is huge in the S&P 500. It's the top performing.
It's not quite an S&P 500
company,
yet,
I think,
but it should be. Maybe by the end of the...
I thought it is.
It might be by the time this podcast goes out.
Let me carry on. I thought it was in the S&P 500. All right, maybe not.
It will be.
Anyway, he's got a new talk called 21 Ways to Wealth, which again is really insightful. Put aside the Bitcoin cryptocurrency thing. Just listen to what he's got to say, 21 Ways to Wealth. It's about half an hour talk, and he's done some other previous amazing talks. So anyway, my strong recommendation is to check out Michael Saylor talks on YouTube.
Okay, cool.
Nicholas.
Thank you very much. So, what's next? Well, this is another. Yes, I'm sorry if the news is a bit doom and gloomy at the moment. We were saying before we hit record, and then hit record again, and then hit record again. We were saying before we did that how it's all a bit doom and gloomy out there, but then it is what it is. So we got a report on it, and another UK listed company is off to list properly, fully in America, and no longer list on the FTSE. The company is called. I'm going to get the name wrong here. I never quite managed to get. Indivior, which helps people with opioid addictions in the US. It provides drugs to wean people off these things and opioid addictions.
Is that Narcan? They do Narcan or something, don't they?
No, their ones begin with S, my friend. Sublocade and Suboxone. But I can get you either if you want, but they're the cash in hand.
All right, so the other companies made billions by selling all these opioids, like the Sackler family. And
I wouldn't like to comment.
Now there's another company to get you off
this
the
is
stuff.
the one when they OD on the street. Issue this stuff, and then boom, they're out of it in like 4 seconds. It's
amazing. And it's just it's again as the UK stock market becomes less and less relevant in the world. Just reading here from the Guardian article, there's a link to it in the so-called show notes. Last year, the London market, lost 88 companies that delisted or transferred their primary listings elsewhere, the most since the 2009 financial crisis. And nobody seems to give a shit, and nothing seems to be done about it. One of the reasons that Indivior quoted for totally not listing the UK anymore was regulatory burdens and administrative costs. And in those 5 words, lies a whole host of evils, I would say. So, well, okay, I don't know. One day it won't exist, the UK stock market, the way things, it really won't exist because it's just shrinking in value and number of companies year on year. And if that continues, it will just disappear. And you might think that's far-fetched. I don't know. It could well happen. Any thoughts on that?
But oddly, hasn't the FTSE 100 just hit an all-time high, which is again
it has, but that's more
an oddity.
The backdrop of the economy and the kind of stocks that predominate, and that's certainly over the last year or so. But yet,
it's been underperforming for so long.
I mean, but it's
loads of people have been
worrying.
Taking off the market.
You're right. There is, and we can't ignore it. There is a sentiment. I mean, I was saying it at Trap Live. Quite a lot of our topical tidbits then were a bit doom and gloom, but we are reflecting our experiences, our conversations with our peers, with our clients. It is a bit doom and gloom. Maybe it's darkest before the dawn. Maybe things will turn around. Maybe things will change. Don't want to talk about politics because Duderino 72 might get upset. But it's tricky out there, and it is worrying. So the UK, I guess obviously part of this story is because of the incredible growth of the US market. But the UK has just shrunk. What are we, 3% of the global market cap now?
Yeah,
3.5%,
just about,
or something. But I did read something the other day, which was quite incredible. Just in the last 3 years, the US listed market has increased in value by about $20 trillion, and Japan's total market cap is about $7 trillion. So the US has added 3 Japans in the last 3 years.
Alan, just to break in here, and you can probably hear it in my voice now, but you were crackling up a bit then. I probably am as
No,
well. I suggest
Nick,
we
you're
just
actually
power on with the
okay.
recording and hope that it renders properly when we put it together. Okay, so let's just crack on.
Okay.
Who's next?
Is it me?
You, Tree. Alan.
Yeah. Okay. I made a bit of an error last time. Well, not really, but I mentioned that I'd been speaking to an advisor who was running a great firm, and he was recruiting just in London or the southeast. And I put that out. I said, anyone wants to get in touch with me, I'll connect you. And I ended up getting about 20 or more people contact me directly. And I did. So forgive me if I haven't replied to everyone because I got quite a few messages. But I did want to connect.
You should start a recruitment company.
That's a whole other story. Building a trap jobs board would be quite interesting, because we all, this is, we mentioned it earlier on in terms of the trap demographic. There are quite a lot of young financial planners who have listened to the podcast and think, hang on a minute, this sounds pretty good. This concept of full fat financial planning is something I'd like to be part of, but it seems that my current setup, the company I'm working for, isn't embracing that. So there's a lot of people who are looking for opportunities. I'm going to say another one, but this time I'm going to ask you not to contact me, and I have this company's permission to flag this up. There's a really outstanding financial planning company who are a relatively new startup. I say they're sort of a few years old now. Full disclosure, I am an investor in them, but they're called Y-Tree, like the letter Y followed by tree, as in things that grow, Y-T-R-E-E. And Y-Tree are a really kind of modern, digital-based, full-fat financial planning business, kind of at scale. And they are absolutely flying. They say they've been off the radar for quite a period of time, but now they're kind of going full tilt, and they're recruiting people, recruiting planners, trainee planners, and actually, we mentioned before, computer engineers, all these kind of coders and people to build their own tech and software. But if you are looking for an opportunity, and if you're good and competent, because they hire really, really top people, get in touch with Josh at Ytree. I think it's ytree.com, and send them your details and your
Tree?
Yeah.
.com.
Yeah.
So is it Josh at y-tree.com?
Well, just do a bit of research. That's part of the process. You've got to find a couple. Josh Duggan, his name is. But get in touch with Josh. Tell him Trap sent you, and ask for have a cup of coffee or a conversation with them, because they are a business which is absolutely going places. That's it.
Okay, very good, very good. Thank you. Ultra, you got a new book to lick.
Yeah, this is, again, a strong recommendation from me. Mr. Nick Murray, the advisor to advisors, has come out with a new book. It's very rare that he publishes a new book. He did about 4 in 20 years, and he did a couple sort of one after another. The latest one he did was scripts. This one is called This Time Isn't Different. It's always very hard to get it as a UK advisor. So it just sells to like the US and Canada. You can get the digital copy, which I'm halfway through at the moment. This is a book that you buy the physical copy and you give to clients. Certainly ones that you think are going to be banging on the door when the market does its perfectly natural thing, temporary declines. And he's focusing on sort of 3 key messages. Anyway, the follow-on link for this, I've mentioned it before on the podcast, but that was many moons ago. Now we've got hundreds of thousands of more listeners. So I'll remind you of it. There is a website in the UK that sells Nick Murray books. The website in the UK is called simplewealthbooks.co.uk. There's a link in the so-called show notes, as Nicholas says. So simplewealthbooks.co.uk. It's a UK site. He's basically bought 100 of the books from America, sent 3 ways around the world, landed in the UK. Now he sells them directly to people in the UK. I believe there's a discount code. The discount code is HUM5, as in HUM5. If it doesn't work, don't contact me, but I think it does work. HUM5, you get 5% off. So, yeah, check out simplewealthbooks.co.uk. I've asked him, I sent an email, said, are you going to buy a load of the new Nick Murray ones, which is the This Time Isn't Different book? And he's not yet got back to me. Maybe I'll check my emails and confirm later on. But yeah, that's it. So there's a new book by Nick Murray. It's going to be absolutely brilliant. And the more content and messages that will keep clients in their seats, during their investment lifetimes and journeys, the better. So I'll be buying 50 to 100 of these books and giving them to as many clients as prospects as I can. That's it.
Okay, good stuff. Mr. Stevenson, another merger.
You kind of mentioned this already.
We've kind of talked about this, I think.
Yeah.
Okay.
Matty Woods and Kingswood.
Oh, yeah,
We
that's the
talked
one I
about
zoned out
Kingswood.
of. You did talk about it.
Yeah.
Okay, you're right. Thanks for that.
Pay
Mr.
attention.
Hart, rumours of changes. Oh, my God, go on.
Yeah, so this one has been doing the rounds in the media, mainstream media. So the rumours of changes to salary sacrifice in pensions may be announced in the autumn budget. There's obviously a huge benefit of opting to make your pension contributions as an employee via salary sacrifice. You save personal national insurance, and your company also saves some employer national insurance. So it costs the Treasury, a big amount of money. Obviously, this is a delicate subject because, the idea is they want to encourage long-term savings and not be, tinkering around with the pension rules, which is what they're always doing. It might be short-term thinking, as in we're going to make a bit more money now, but then if people are bloody destitute when they should have loads of money in their pensions in 10, 15, 20 years, so they might be brewing a bigger problem down the line. So any changes like this are, discussed far and wide. So potentially changes to salary sacrifice and employees. Any thoughts?
Is there any indication as to how much is raised or saved or the HMRC lose out on? Because often they'll dabble around with these things, and
is a bit of a loaded statement.
Well, it's like they've got a number for how much tax relief is given to just normal pension contribution. They know these numbers. So the reason I'm asking that
drives behaviour. So the whole reason
exactly.
why,
But look, don't get me started. Doing my very best not to be political here. But I mean, a couple of things recently. I think we talked about this on the last episode, or the famous Laffer curve that the raised capital gains tax and the most recent data, the amount of actual revenue raised by capital gains tax has
declined.
Fell 10%.
People delay, people tweak,
people put off. And we'll come on to this in a second with Rob. But if you're going to sell a business, but you're not desperate to do it, you think, well, I'll just hang on a minute. We'll see what will change. And I saw something else yesterday, which was, the inheritance tax applied to farmland and to private companies and family businesses. Well, latest survey on that expected to raise 1.8 billion, which again is a bloody rounding error to the rate government, and it's not just this government or past governments. So the rate they spend, it's neither here nor there, considering the disruption. But again, incentives drive behavior. So a lot of these family businesses are no longer recruiting, no longer growing, no longer investing. So the latest statistics from the research that has been done is that they're going to have 2 billion less in terms of tax revenue. So try to raise 1.8, end up losing 2. Because unfortunately, politicians don't seem to understand human behavior and the importance of incentives. It's just freaking nuts.
Yeah,
it drives me crazy.
There's no excuse for it. There's been something. The Laffer curve is so old now; it's 50 years old. I mean, it's not.
But you would think, would you not, that before you're going to make a material change that impacts thousands, hundreds of thousands of businesses, you would do some research, ask some experts, some consultants, some tax people. It seems well, I mean, if they are, then God forbid, because they are announcing these rules without really understanding the potential impact of them. Normally you would do an analysis, a study. If we did this, but what they do is they launch these things, and then the market just reacts. And they say, now we're going to have to back and change it.
Of course, they do a lot of analysis and reports and get in very expensive consultants. But sometimes the intended consequences and unintended consequences are very hard to predict. It's not an easy thing to be balancing what they're doing. To support.
No, I'd push back on that. This was bloody obvious it was going to happen. The CGT one was bloody obvious it's going to happen. You didn't need to be a metropolitan.
I don't think yet we have enough data. We don't have enough data yet, and also the change coming in with private companies is not even in yet. It's in April 2026. The pensions
but companies are already saying if you've got a family business, well, what's the point in us growing and hiring people and investing? Because we've got this, we've got an issue now about passing on how we're going to, deal with this tax liability that we hadn't had up until now. So, hey ho.
Interesting. Okie dokie. All right. Okay. Right, so the final point here was Wodge, but Wodge will carry your point forward, surviving you on the assumption you're around for next time.
Is it
Do
May
yours.
Hooray?
Just about recovered 2 weeks from now.
So we will
Heroes.
about nearly at 40 minutes, which is just about perfect. We'll move on to the meat and potatoes of the show. This is where we take a deep dive into an aspect or a personality in this thing of ours. And of course, we do have today our very esteemed guest, Mr. Rob Stevenson. And we've got some questions for you, my friend. I think Storyteller's going to lead off. And we'll take it from there. But this next session will take around 15 minutes max.
Yeah, Rob, good to see you as always. I was reflecting before you coming on this that I've known you pretty much as long as I've been in business. I think I set up 21 years ago, and I really didn't know what I was doing. I know a little bit now, not much more, but I was looking for sort of guidance and direction. And I think, to be fair, you weren't quite sure what you're trying to work out exactly what specific role as a consultant that you were going to do. But so you and I pretty much known you. It must have been one of your early clients. And so we've known each other through the ups and downs and everything in between ever since then. And I've always really respected you and admired what you've done. You've been super helpful to me over the years.
I was going to say,
I just think it's really, really good to have somebody who understands our sector really, really well, but isn't. It's like why anyone would hire a financial planner, but they're not emotionally attached to the outcome. So when there have been a few moments when I have been slightly emotional. Would be a phrase that Rob has kind of been the voice of reason. But Rob, I'm interested now. You've evolved your consulting role, and you spend, I think, most of your time, correct me if I'm wrong, in what we call M&A businesses, growing and selling. But just clarify, because you do other things as well. You focus on businesses that just want to grow, for example? But just let's share a couple of minutes in a bit of the detail in terms of what you actually do now and what your role is. So
just to go back to the first time I met you, we sat in a room at Great Queen Street for about 20 minutes, kind of sizing each other up. You went, right, I'll be back in a minute. And you ran off and you came back with like a ream of paper. And you dumped it on the desk and you went, this is strategic coach. If you can turn that into something, I'll pay you.
That's right.
Like, thank you very much.
Yeah.
And it was everything that strategic coach is great for the idea, but the implementation is like, you come back, that's where it falls down. You come back and you're kind of like, well, what am I going to do with all this stuff? There's this great exercise that Dan took us through, but like, what does that actually mean? Is it useful for me or not? So kind of where I started, and it was 20 years ago, was we've lost Nick.
Yeah, don't worry.
He doesn't care.
We call it, this is big boy shit. It just
big boy shit.
Doesn't
grown ups. Kids can leave the room for this bit. The original idea was I do M&A and that's success fees, and then I do some consulting in between. And at the time, it was like treating customers fairly. And there were a few firms like yours that were a bit more sort of forward thinking, like how do I grow and stuff like that. And I guess 20 years later, it's the same. It's actually the same thing. So probably most of what I do is succession, whether it's firms that are a long way back from that and they're thinking, how do I grow this business and just get to the point of kind of, having a good lifestyle, and potentially I might build some value in the business and I might have, the chance to get where I'm trying to get my clients to, financial independence in the future, that kind of thing. Some of them are much further along. So these are firms like, that were turning over a couple of million, now turning over 10 million. And so we've worked together for, in some cases, 20 years, not constantly, but, backwards and forwards where they need me. And the focus there has always been on building enterprise value, sort of how do you kind of scale that business and how does that work? And then obviously, when we come out the other end of it and old Father Time knocks on the door, then I help them ease them into retirement. So it's, I work on probably a dozen deals a year. But I guess I am sell side. So without to get into too much terminology, there's an important distinction. So I worked buy side. I worked for a firm and we were buying companies. And then I am sell side now. All the consulting I've done is all sell side. So if I'm selling a company, I'm selling it. I'm representing the seller. They pay me. And there's an important distinction. Business brokers are typically buy side, but it can feel often like they're sell side. And they do care about the seller, but they're ultimately paid by the buyer. So I took a very different, position because everyone else was, buy side, and I could have done that and done very well at that, but because of the consulting, I wanted to be on the sell side. So a whole bunch of firms that I've worked with for extended periods of time and then sold, and continue to do that now. Because of the consulting, it allows me to get involved in debt finance, management buyouts, EOTs. So, the core of what I do is the planning. Is people come to me and say, well, I don't really know what I'm doing. And so we go through a process. I came from a financial planning background, and so I use a very similar financial planning process, but it's just for, numbers of people and, entire companies. So
it's really interesting what you do, Rob, because I would say you act as in many respects as a financial planner to the financial planner or business owner. I think you've still got them on your website. There's a lot of good collateral and downloads and resources, which I've made use of, where you kind of, I suppose, you take the same approach as I might do if I was meeting with a prospective client who wants to talk to me about their pensions or something. You go back to say, well, what's it all about? What are we trying to achieve here? What's your kind of idealized lifestyle? And trying to look, 30,000 feet helicopter view rather than get deep in the weeds. And so you apply the same philosophy and strategy, I would say, to that, because you've got you've got a series of workbooks. Am I right in saying?
Yeah.
I guess you encourage people to think more about, right, can you sell my business for me, Rob, which is a kind of normally a sell side corporate finance advisor. Yes, of course I can. I'll go and you're more like, yeah, but why do you want to sell? And, let's go into it a little bit more depth.
Yeah, I don't deal with listed companies. That's way outside my wheelhouse, and I wouldn't want to anyway. Ultimately, I deal with small businesses, and the owners of those businesses are doing it for their families largely. They love their clients, but they're kind of doing it for themselves and their families. And so the definition of shareholder value is just not more profit, more growth, at all costs. It is, yes, profit, growth, enterprise value, business value, whatever terms you think of it in, but that's balanced with lifestyle. It's like, what are my relationships like? Is my health okay? Am I satisfied with my career? I'm not just banging my head up against a brick wall to finally retire and have a heart attack on a beach in Egypt. It's like, that's a poor outcome, right? So what do we actually want to do? Suboptimal.
Was that a true story, Rob?
Well, I've lost a few. But
yeah.
On a long enough timeline, the numbers are there.
You're going to lose a few.
You're going to lose a few, yeah. But ultimately,
go on.
It's trying not to, yeah.
Rob, what is? I've just got maybe one more question, and I'll open up to the floor. I don't know if you saw. I got there's loads of these things flying around. I received a report the other day about. I think it was a corporate finance Heligan consultant.
Yeah,
I think.
Yeah, I looked at that.
So I had a look at that, which was their company that gets involved in this stuff. I don't know them. You might know them. And it was just kind of their overview of the financial planning, wealth management, state of the market, M&A, as of now, as of kind of bang up to date. And it seemed to suggest the market remained, despite all sort of the headwinds that we've talked about in sort of commercial world and business world, market remains very vibrant, a lot of deals getting done. What's your take on the current state of the IFA M&A market right now?
Well, first of all, most of the reports, the corporate finance stuff, is usually deals that are 5 million plus. So Marshberry do one, and they bought out a broker, a corporate finance house of, from that have been doing this for years. So a lot of the smaller deals are unreported. So the bigger stuff is kind of what they're looking at. So they're looking for data points and they look for bigger transactions that, I come from a sort of proper full fat financial planning background, and these are businesses that they're more like a wirehouse in the US versus an RIA, so they're more like the old fashioned kind of scaled. Everyone calls it financial planning, but it's actually a fact find and a risk questionnaire, and a ISA and a SIP, and that could be fine, and there's space for that, but that's not the same as doing that job of what makes you tick. What are your values? Why? What are you trying to achieve? What are the things that you want to do in your life? What does your perfect day look like? The bigger stuff. And I think, so the data points are very much that. But also, I think that there are very few people that have been both buy side and sell side. So you have an opinion because you sit on one side and you're talking to a particular audience. To answer your question, I think I think it's a little bit artificial, but there is a drive with companies looking to sell out because the business asset disposal relief rates are going to change. So there's a bit of that going on. I think demographics are probably more of a push. You guys, and Andy is the exception here, but you guys are not getting any younger. And well, yeah.
Thank you for reminding me.
I don't think Andy is getting that older, is he? I think he is getting younger, but
Benjamin Button.
Thank you again.
Most of my clients are kind of at least 5, if not 10 years older than I'm 53. So a lot of them are like, early 60s. And so they are thinking, they enjoy what they're doing, but at the same time, it's like, I have got to deal with this. And succession planning is not about how much is my business worth and who wants to buy it. That's selling. Succession planning is about what is it that this business, why is it unique, and how, and what commitments have I made to people, clients, team, all these things, and how do I perpetuate that? How do I continue that? How do I pass that on? And is it best doing internal, external, and all the demographics around, the differences in generations and whatnot. If you know what you're doing, Kingmakers, all that. If you know what you're doing, then I don't think the actual metrics and valuations have changed fundamentally. The terms in which people talk about things have changed. So people don't talk in terms of recurring revenue anymore. They tend to talk in terms of operating profit or EBITDA. But nothing's changed, right? If you work buy side, then it's an investment. So you sit there and you look at your discount rate and your terminal value, and you look at your internal rate of return, your MOIC, multiple of invested capital, all of these different things, and you look at how much do I need to pay for this thing and what return am I going to get for it. None of that has ever changed. It's just the way it's being discussed. The narrative has changed a little bit. And I think that's for the better, in terms of what that is. So people are now starting to fixate a little bit more on what makes a business worth a higher multiple. So, you've got £1 million worth of profit, then what makes it 8 times that million or 10 times? And that's work I've been doing for years and years and years. So I'm happy that we've kind of caught up.
Just following on from the point you made there, Cole highlighted a question he wanted to ask. So if a firm is planning to enhance their enterprise value, which is the point you just made, what are the key areas to focus on? If you would have to sort of do a top 3, top 5 key areas to focus on to basically build the enterprise value of an IFA financial planning firm?
It's an easy answer, but it's not a very helpful answer. The easy answer is that you want 35 to 40% profit margin and you need 20% compound annual growth rate. And with you coming out of it as the founder, those two things can continue. Everything else, it sits behind, but ultimately high profitability, high growth rate. If you think about what a valuation is, what a sale of a business is, it's a capitalization of expected future cash flow.
Yeah,
that's all it is. It's like, I'm betting, Andy, I'm going to buy your business. It currently produces £500,000 a year in free cash flow, and I think that that's going to grow, and so I'll multiply that by 6, 7, 8, and I'll give you a number. And it's a bet, right? It's an educated bet, but it's a bet on expected future cash flows. So the trick to all of this is you have to think of your business becoming a business unit in a larger business, and what is going to happen to it, what costs get stripped out, what revenues get added, hopefully, and what's the outcome for the buyer. So the trick is, as a seller, is to put yourself in the buyer's shoes.
Next question. Is there a lot of, as they call it, dry powder out there, a load of cash that needs to be allocated, or is that ship sailed and now the interest rates are rising, so there's less dry powder out there? What are you seeing in terms of that?
It's like shipping containers. So if you load up the capital, it's going to have to take its journey. So you've got money that was committed. If you've ever raised money, it's never again. It's very difficult and it takes a lot of time. And back to private equity, if it's a closed-end fund, that's typically 10 years. So the money that's being committed has been committed a while ago, several years ago. I think at the moment there are some pretty high-profile companies who are recapitalizing, which is shorthand for being sold from one PE firm to another. So they might not characterize it that way, and we won't get into the intricacies of cap tables and stuff, but ultimately they're changing their investor. And I think as that happens, the economics of deals change, because that's then a third party who's investing saying, right now, cost of capital is X, equity risk premium is Y, weighted average cost of capital is Z, and therefore that might start to push prices down a little bit, which is much more.
Just to give the listeners a bit more meat to the bones, can you share anything about sort of rule of thumbs in terms of valuations and stuff? I mean, I've always looked at companies buying and selling, and I've just used a shorthand heuristic of basically 4% of assets. So if a company's got 100 million AUM, usually, however you slice and dice it, they're probably going to get sold for 4 million quid as a starting point. Can you add anything to that? Does that sound ballpark correct? Is it 6 times net profit, 8 times PEs and all the other stuff?
So if you imagine you had a piece of paper and you do a T-bar and you put past and future. So if you're looking at the past, it's kind of past and present.
Yep.
That is what we call relative values. So you're using multiples of whatever type of valuation relative to what other transactions have happened in the marketplace.
Yep.
So you're essentially going, assets under management, there's a company over there, it was sold for 3% of assets or 2% of assets. Yep. That is not how that deal was constructed. It's
I know that.
In retrospect,
when I back the numbers out,
as a proxy. So percentage of assets under management is kind of 2 to 3%. I think 4 is probably if it's a restricted business. If it's recurring revenue, then that's like 3-4 times, and there have been deals that have been much higher. Again, the deals tend to be higher where there's a bit of scale involved. Maybe there's Central London has always got a premium to it, particularly if consolidators don't tend to have Central London, So
his ears are pricked up.
Yeah.
Oi.
Yeah. And Capital as a website, that really, there's a massive premium for that, obviously.
Don't get him talking about that.
And then EBITDA numbers, little firms are 4, then 6, then 8, and you can get 10, 12, 14, but you've really got to have an absolute USP, a real kind of moat around the business and growth and all these various different things. That's all sort of present, but then the future is what we call intrinsic value, which is where you're doing a discounted cash flow, which is where you look at the future cash flows and you bring them back to a net present value. And ultimately your discounted cash flow needs to be higher than your relative value. And that's where you start. The real action is in that delta.
That's awesome, Rob. We are going to have to nudge on. But my final question, when we had a breakfast at that lovely cafe in Marylebone the other day, you were telling me about potentially writing a book. So share with the listeners what's happening about that.
I'm actually still trying to digest that breakfast. That was pretty heavy. Yeah, like a snake.
Considering you had a curry about 6 hours prior to it.
Yes, it was it was everything everywhere all at once. That 24
That's
hours.
what Carl Widger is right now.
I have. Yeah, despite the fact that I sound like I can't connect all my knowledge together, I've written 2 books actually. One of them's kind of resting. And this one's about the first one's about growth and growth stages and how to navigate that. And it's for financial planners. And then I kind of diverted off into doing one on succession planning, which is very, very, the first shitty draft is done on that completely. So I'm in the editing phase on that, and that'll be coming out soon. It's also coming out with a digital course, so you can go through, and there's, case study and stuff. And so you can work on your own succession plan, which covers MBOs and trade sales and EOTs and the whole works. And then later in the year, maybe early next year, we might be doing some group therapy, so we can all get together and sing Kumbaya and work out your succession plan over sort of a year, that kind of stuff.
Kumbaya, my lord, kumbaya. Kumbaya, my lord, kumbaya. Kumbaya.
Brilliant.
I think that
we will put Rob's website in the show notes, but it's kingmakersgroup.co.uk. You can pop your email address in there, and if any new books will be announced, I'm sure he'll be able to email you about that. Sorry, Alan.
Yeah, if you sign up for the newsletter, you'll get on there's only one list.
Yeah,
so
I would encourage anyone who's a sort of senior position, running a business, owning a business, just to start off by, subscribe to your newsletter, download some of those resources, really, really helpful, I found. And then there's quite a few people sell side kicking around. You've got that sort of, I just think at that specific sector, you're not dealing with the kind of multi-billion pound transactions and listed companies and all the rest of it. You're dealing with predominantly our audience, which are by and large, small to medium-sized financial planning practice. You understand what full fat financial planning is. You've got a background in it as well. So you kind of, I would say you're in a category of one right now, Mr. Stevenson, and people are in that space, even if they're like 3 to 5 to 7 years out, probably worthwhile having a chat with you. So thoroughly endorse. Keep up the good work, and do let us know when that book comes out. I will be a customer of it. That's it.
Good stuff. Good stuff. Thanks, Rob. That was
I'll be in a bar somewhere in Marylebone.
Look forward to it. I'll be there too.
Know.
Bar or greasy spoon. Very good. Okay, let's move on to the next section of the show. This is where we take questions from our beloved Trappists. I can see the lady postman is at the front door. She's dropped off the bulging sack of Trappist questions, and you can leave a Trappist question either in the pinned tweet on X or the pinned X on Twitter, whatever, or in the link in the so-called show notes, and we will get round to your questions. This one today is from Connor McClarnon, who's also on LinkedIn, and we'll put that in the show notes as well. God, this one can go on forever, so let's be succinct and to the point, please, gentlemen. Hi all. Firstly, wanted to say a big fan of the show. Having only recently found this gem of a podcast, I've went back to the start and began listening in order. I went back, Connor, not I've went back. As a relatively newly registered planner, have you any advice in terms of mistakes you've seen or made in the past that have led to valuable lessons? Good grief, that is a show. I think
we've done an entire show on mistakes.
So let's be pithy into it, like 30 seconds each.
I've got a bullet point list. You want me to go?
Yep.
I'll go. Right. See and speak to as many people as you can about money, but be selective of the clients that you take on. Use a capable platform. Don't focus on costs, focus on capabilities. Learn Voyant inside out. It's the tool of this trade. Become really good at building financial plans. Learn about asset class investing and turn off the noise of active management. Join some communities, for example, Next Gen Hum Advisor 3.0 PFS. Read all you can about from Nick Murray.
These are the mistakes you made. Okay, fine. In terms of
I get what you mean.
Look, I'll tell you,
avoid
that's the opposite.
So whatever. All Andy's list, just don't do the opposite of that.
If you're not doing that, you're making mistakes.
Yeah, exactly.
Yeah, basically. Sorry.
I've just got a couple that I've learned. School of Hard Knocks, which is, well, to follow Andy's lead, it's simplify. So there is a.
That's not a mistake, though.
No, but there's such a temptation, and I've done it, to complicate everything, to look at the next shiny new object, the next tech, the next platform, the next fund group, whatever. This industry, this profession is actually really, really simple. So do it with the minimum possible friction, one platform, one investment solution, one set of tools, just all that. Just do not, everywhere you go, there'll be people selling you more stuff. And just don't. Find the best and stick to it. And the only other one I've got, again, the mistake is not sticking to your guns. When I started to do proper financial planning and have kind of deep and meaningful, and the song Nick played a second ago was very relevant to this, so kumbaya type conversations, hugging a tree with some pretty sort of high net worth type entrepreneurs and clients. And I was talking to them about what money was like growing up and all that sort of stuff. And it was a bit... It was really awkward because I was kind of just, going through the motions. I'm not sure if I fully believed in it, but I did. And I stuck to my guns, and clients actually like it. So there was a temptation to say, oh no, we're British. We're not going to talk about important things like life and family. The mistake would be not to do that. Stick to your guns, embrace full fat financial planning, and have meaningful conversations consistently with your clients, regardless of their status in life. Nicholas.
Okay, very well. I haven't really got much to add because I'll just be repeating really what Ultra said in the list of things that you want to do to avoid making mistakes, and what you said there about Alan about sticking to your guns. I mean, that's, as you know, my personality traits. That is a big part of what I just find out what you think is right, and then just stick to it, and then let the chips fall as they may.
Just a brief note, Nick. Sorry, Rob is actually a back Belly Advisor client. He's not a knack. He's a back. Rob, any mistakes to avoid?
Yeah, thank you, Andy, because I wasn't going to involve Rob in this conversation, but thank God you're here to pull me out the weeds.
Look,
I think that you should not do any of what you lot said.
Yeah, exactly.
I think you should. I think actually spending a lot of time with other advisors is not it. I think that ultimately you want to spend time with clients. You want to do work for free. You want to get to that 75, 100, 150, whatever your max number of clients is. Your only job is to get to capacity. And to do that, you stick to your guns. You go, this is my proposition. And you just go out and you just do it and do it and do it and spend all of your time in front of clients because they'll tell you what's right or wrong. And ultimately, then once you've built a business at that level, then you'll have to unwind all of that and do it all to try and get yourself out of it, which is a completely different and wonderful challenge, but different.
Okay, thank you, Rob, and thank you for your contribution to this show. So, without any further ado, I think it's time for us to move on to what many people call Culture Corner.
I can see Nick is going through this whole episode at a hell of a clip. Have you got lunch coming up? Lunch club?
And he's got
It's not really. It's 64 minutes in, and I have got a client meeting in Kensington in just over an hour.
You got plenty of time. Okay, but this is one of our faster episodes, so it's probably not a bad thing. I'm going first with Culture Corner.
Yep.
I'm a great fan of a guy called Scott Adams. I think you guys are as well. He was the original creator of the Dilbert cartoon strip and a whole bunch of other stuff. He's written loads of books. He's got a daily podcast.
Great books.
And very sadly, he announced just a couple of weeks ago that he's been diagnosed with terminal cancer. And he's unlikely to be with us even in the summer of this year, in a few months. Hasn't got long to live, which is really, really sad. If you haven't come across Scott Adams' work, go and check it out immediately. I just think he's one of the best, deepest thinkers, most insightful creators, authors, whatever I've ever come across. He's written loads of books. The one that I am going to recommend, if you haven't read it yet, is called Reframe Your Brain. Just an entirely different way of thinking, how you can effectively just rewire your brain. We often think about things and moan and groan and shit, I've got to do this, I've got to do that. He has just, the pages are packed with ideas and suggestions how you can rewire and reframe just by thinking about things differently. And I really think there is a lot of application in financial planning, both in the day-to-day work we do and also the conversations we have with clients. When I was just reading through it again recently, I thought, wow, that would apply next time I have a conversation with a client, just restructure, reframe. So I recommend Scott Adams, Reframe Your Brain.
Yeah, he also reads his own books on Audible. So if you're an Audible listener, check him out there. Nicholas?
Thank you, Andrew. So I read a business book, which is not something I do that often, but I read this book, The Thinking Machine, Jensen Huang and NVIDIA, the company shaping the future of AI. I heard Jensen Huang, he was one of the co-founders of NVIDIA back in the late 80s, early 90s, him and two other chaps. And they thought, we can make a business launching gaming chips, because they saw it was coming with Nintendos and Segas, and Intel, who were the biggest chip manufacturer at the time, kind of looked down their noses at this and said, no, we're just doing business and supercomputers. So NVIDIA found this little angle. And of course, we know what's happened since then with NVIDIA. They've met these CPUs and these GPUs, which are powering these neural networks and everything else. He's a brilliant, if you listen to him, he's on some podcasts. Just Google Jensen Huang and podcasts, see what comes up. He's a very engaging guy. The story is riveting. Some of it is a little bit too much in the weeds for me with all this AI and how it works, but it is an amazing story of how this guy is a workaholic. He's in the right place at the right time, but his staff love him. NVIDIA has very low turnover of staff. They mainly leave because they're burnt out. NVIDIA, or Jensen Huang, his big thing is you have 6-month cycles, and then a new product update comes out in 6 months' time. So all these gamers back in the 90s had to have the latest NVIDIA chip. And then 6 months later, they had to have the other one. But of course, that means all the engineers are under incredible stress. But the thing I took away from it was the guy saying that in Silicon Valley, Jensen Huang is one of the genuinely nice and humble people who sometimes has to put on the appearance of being an evil bastard. Whereas most people in Silicon Valley are evil bastards who sometimes put an appearance of being humble and nice. Really good book. Race through it. You don't have to be massively into AI or tech to understand this story. Really, really interesting guy. And he just have an hour with him on any subject. I think he'd be very entertaining.
Wow, I might check that out, Nick. I mean, the latest numbers are insane. I think the last quarter they did something like 44 billion.
We should say again, this is The Thinking Machine by Jensen Huang, because some of the trappists say we go through these things and we don't repeat the name of the book often enough. Sorry.
But there's always links in the show notes for those who were just...
Yeah, but some of our trappists can barely read and write, Alan. We know this. Come on. Okay.
Yeah, the latest numbers from NVIDIA are insane. I think the last quarter they had 44 billion revenue, 19 billion net profit. They're again the... number one valued company in the world. It's an insane story. Yeah, I'll probably check that out, Nick. Thanks. My point is a YouTube interview called The Investing Show. Robin Powell is the host, who some of you may know, but he's got the amazing Jason Butler on, who's a force of nature. Check it out. It's very funny.
I love it.
It's really good. It's really good. So check it out. Jason Butler's also on... you've got another podcast, haven't you?
Yeah, he's been on my award-winning podcast, The Bulletproof Entrepreneur, as Jason is. As Rob knows,
it's worth checking both of them out.
Serial entrepreneur.
It's a good use of an hour and a half of your time. So listen to the one in the so-called show notes, and then listen to the Alan's
Now,
one. I mean, the quote of the show, he said, "The vast majority of the vast majority." I quite like that saying. It's just
That's
such
very
a Jason
Jason.
Butler thing to say. Very Jason.
now
Anyway.
our guest is taking liberties. He thinks he can shoehorn in 3 culture corners.
Choose the best
Roberts, you're limited to 1, so pick your favourite.
Oh, really? Okay. So the podcast with this guy who started and ran Touchbase. His name's Rian Maynard.
What's Touchbase? Sorry, Rob.
Touchbase was a huge business in the US that was doing kind of telecoms and stuff like that. It's a really simple business. The link's in the show notes. The interviewer is Jamie Lang, the guy who was originally on Made in Chelsea, I think. Yeah, that guy. So not something I'd normally see, but ultimately I think he'd done an interview with Rory Sutherland, which is why it kind of the algorithm threw it up for me. Absolutely amazing podcast with this guy who started a business with the best intentions. It got a bit out of hand, and he wound up defrauding the IRS, and he was sent to jail in the States. And he spent 6 years in jail in America in various different prisons, and has come out of that. And it struck me for a number of different reasons. One, because you talk about the Laffer curve and people sort of going, I want to delay tax and defer tax. His is such an innocent story that wound up with him getting shackled and thrown in jail. And he goes through some of the experiences that he had in jail, which is just really kind of scary, like petrifying, But one of his, I think it was his brother, sent him, and this is hat tip to Carl, sent him Man's Search for Meaning, the famous book by Viktor Frankl. And so he read that, and that started to get him along the path of reframing his experience. And, it's about optimism and it's about hope, but ultimately it's about logotherapy. Logos is the Greek word for meaning. And so essentially he's now started a business coaching people based on logotherapy, which is a sort of punchline to it. But for an hour and a half of your time, it's something different and it's really interesting. And he's a really kind of gregarious, interesting. You can see how he built a business and everyone loved him. He's just a really wonderful character. And I thought that was just something really different.
Rob. That's the Great Company podcast, which I have.
Yes.
Okay, I shall listen to that. Thank you, Rob.
Excellent.
I sat next to Jamie in Harry's restaurant in Marylebone a couple of weeks ago, so now he's a close personal friend of mine.
He's a close
No
personal
idea
friend.
who he is.
Yes.
Andy, the ultra-crepidarian Andy. He knows about everything, Andy. Can't be told anything. His name is Andrew Hart. Andrew Hart!
Right, mic drop.
That's
He's
an hour
he's
and
gone.
12.
Heart's gone.
That's an hour and good. That's an hour and 12 minutes. We've given our best today. I want to say thanks to Rob Stevenson for
thanks,
standing
Rob.
in
Appreciate
the shoes of Carl Widger. Easy shoes to fill, but you did it. You did it very well. There you go, dear Trappists. As episode 72 comes to a close, another pile of traps slides down the U-bend of Father Time. Thank you, dear Trappists, for your precious time and input on the show. Rate us, leave a 6 out of 5 star on iTunes or what have you, or a 1 out of 5 star review if you're that kind of embittered person. Like and subscribe to our YouTube channel. But until the next time, dear Trappists, it's adios from us and take care out there. We will see you on the other side. Goodbye.
Bye-bye.
Bye-bye.
Oh, Christ, I'm dying over
we
it.
got there.
Right.